Lease Corporation leases out airplanes. They're a fairly big company, $5 billion. Pay a little dividend, but a lot of people are interested in it because the PE ratio is so low, despite the company being a very fast grower without a lot of dilution. So let's look into it. Is the company buy? Is it not? Let's see. They own 463 aircraft. On average, it's around 4.6 years old. That is not that old for an aircraft. They're fairly diversified with 109 airlines, so they're not reliant on one company, and they're still buying a lot of airplanes. While the amount until 2028 is fairly lower, remember this is just scheduled aircraft deliveries. This is just what they already ordered, they might order more, and basically all of the aircraft are being leased. So why is the stock that cheap? If you think about it, they weren't hit as hard by 2020 and the travel shutdown as the airlines because they just lease the aircraft, and the aircraft are leased for a certain amount of years. The companies can't just stop the lease, so they still get paid even if the aircraft doesn't fly. Matter of fact, it's even good for them if the aircraft doesn't fly because less maintenance costs afterwards, the airplane will live longer. But still, during 2020, their stock plunged to $18 per share. So what is the risk here? While they make a lot of net income, they do not make free cash flow. Now why is that? They keep buying many aircrafts. That is how they keep their revenue growing. If you do not make free cash flow and you're ordering new aircrafts, what does that mean? The debt is going up and up and up and up, and we're at $18 billion net debt. Reminder, the company is only worth $5 billion. Of course, that doesn't show the whole thing. Of course, they have aircraft for it. They're building a lot of book value. They currently have $7 billion in book value. And this book value is true book value. There's no goodwill, etc. This is all just the airplane fleet. You have $7 billion of book value in this company, while the company is only trading at $5.65 billion. Plus, they still pay out that nice dividend. It's not a lot, but 1.66%, while managing to build book value at a decent rate. However, they have to take on debt for this dividend, so I don't really like it. Now, are they ever gonna make free cash flow? I'm not that certain. Things will always be developed further. They will be more fuel efficient each year. Every new airplane that comes out will be better than the last one. And what do the airlines want who lease these aircraft? These new airplanes. So you have to keep buying the new aircraft. Well, what they could do, we're not gonna buy new airplanes, we're gonna continue leasing out the old ones, and just extract the cash from that, and eventually sell them maybe. However, that is not gonna happen. Remember, the managers wanna keep their job, they're not just gonna disband the company over time. I don't think you're really gonna ever see free cash flow from this company. What you wanna see from this company is the book value. As long as they're able to grow this book value, which shows that they have that air fleet, and that they are making money basically, then maybe the stock is eventually gonna go up. However, do not expect ever to get huge dividends or share buybacks from this company. That is just not how the company works. They're gonna keep growing the book value. And when we look at the price to book value, we can see it has steadily fallen, which means if you think this company is gonna succeed and it's gonna continue growing, then you're buying it cheaper than ever. I'm currently buying it for 78 cents on the dollar. So let's do some calculations. How much are we willing to pay for this company? Now currently the book value per share is at $64.50. How are we gonna assume they're gonna grow it? Historically, they have been able to grow it at 9%. But we wanna be conservative, we wanna have a margin of safety. Let's say they're gonna grow at 7% for the next 10 years. Little payout ratio, because they just don't have the money for huge dividends. 1 time the multiple, 10% required return. We would come to $54 per share. You would get around a 10% return. It's not a great buy, but it is a buy. Now what if it goes better? They grow at the historic rate of around 9%, and they get a slight bonus on the book value, because the company is decently well run. Well then, $68 per share. This would be a better buy. What if it goes worse? Airline industry doesn't want to order as many planes as before, so they're not able to grow that much. And the multiple is gonna stay at the very low multiples, 0.8 today. $38 a share, that would be a decent downside. I've never really seen a company that relies this much on book value. This is maybe something to buy in a crisis like 2020. You can make a decent return here. You don't have as much risk as with the airline companies, and you would have a decent amount of upside just because of a low stock price in that cases. As long as you don't think the airline industry is going to disappear for 5 years, I think Lease Corporation is going to be a great buy. Young fleet. They have very long contracts, and they have historically managed to grow in book value. Well, this is something for your watch list, I would say, but I'm not gonna add it to my portfolio. What do you think? Write down below. Have a good day.